After creeping over 8% at the end of 2023, some big players in the mortgage game expect to see 30-year fixed rates drop substantially by the end of 2024. In this video, I'm gonna let you know what those rate predictions are, how lower rates can affect the cost of a home, why home prices are expected to increase when rates decrease, and how to get tomorrow's rates today while not overpaying for a home. The 2024 rate predictions from the big players in the mortgage industry are as follows. Fannie Mae expects to see the 30-year fixed rate at 6.5% by the end of 2024. Bright MLS is expecting a 6.2%. The Mortgage Bankers Association expects 6.1%, and Bankrate.com is predicting 5.75%, which I'm right in line with that Bankrate.com. I actually expect to see rates a little lower than that. I'm leaning more towards the 5.25% range. But let's just keep our fingers crossed that Bankrate.com and Brand the Mortgage Man are going to be the ones that are predicting the exact or lower rates as expected versus what those other big players are expecting to see. So why do these rate predictions matter and how do they affect the housing market? Well, lower interest rates typically mean that we're going to see higher home prices due to increased demand. So a lot of would-be homebuyers, maybe someone like yourself, has been sitting on the sidelines waiting to see interest rates come down before they actually go out and purchase a home. And this is twofold. It could be one, because, well, maybe you just feel rates are too high and you don't want to buy a home with the quote-unquote high interest rates. Two, could be that maybe you don't qualify to buy a home unless interest rates come down, right? The increased interest rates might have made it so that your debt to income ratio, which is what lenders look at when you're buying a property and trying to qualify you for a mortgage, maybe that's just too high with the now higher interest rates, and so you have to wait for rates to come down in order to buy. Let's just say you're now back in the market and you're looking at a home that's currently priced at $500,000 and you're trying to decide whether or not you buy that home now or you wait until we see rates drop further later this year. Well, what I'm going to do is I'm going to show you a comparison of the things you need to keep in mind when trying to make this decision, because it's not always just about rates and cost. You really want to look at how much it would cost you to wait to buy if it's actually going to cost you more than if you purchase today. So we're going to look at a purchase of a $500,000 home at today's rates versus the lowest predicted rate by those big players for 2024. We're also going to look at it if that home were to increase in price by 15% over the next 10 to 12 months based on the increased demand, and what the cost would be at $500,000 using today's rate versus the $575,000, which is a 15% increase on that $500,000 at the lowest predicted rate for 2024. Essentially, what is the cost of waiting and the top strategy for obtaining tomorrow's rates today? What most would-be home buyers are doing is they're looking at today's home prices and they're comparing that to what the payment would be at today's rates versus the payment on that same home if rates dropped. I don't know if this is necessarily the right way to go about it, but I'm going to show you what that looks like, and I'm going to show you what you really should be comparing when trying to make this decision. So, for example, a $500,000 home with 20% down. If the rate is 7%, the principal and interest payment, now just to be clear, I'm only going to show you the principal and interest payment. You'll still have property taxes, you'll still have insurance, but the taxes and insurance on the home are going to be the same regardless of what your interest rate is on that property. So for the purpose of this exercise, I'm just going to show you the principal and interest portion of the payment. But keep in mind, you will have taxes, you will have insurance. If you're putting less than 20% down, you will also have mortgage insurance you're required to pay. But this is specifically $500,000 with 20% down. So at 7%, the principal and interest payment is $2,661 per month. Let's assume rates drop to the Bankrate.com predicted rate of 5.75%. On that same $500,000 purchase with 20% down, the principal and interest payment is $2,334. So that's a difference of nearly $330 per month versus buying now at $500,000 with a 7% interest rate, or waiting till the end of 2024 and purchasing at $500,000 with a 5.75% interest rate. However, the problem with doing it this way is that realistically, if you wait to purchase at the end of 2024 when rates do come down, and let's say they do hit that 5.75% rate that's projected by bankrate.com, it's very unlikely that you're going to be able to purchase that home that's $500,000 today for $500,000. What you really need to be comparing is the home at today's price and today's rate versus the home at tomorrow's price and tomorrow's rate. So what I mean by this is that rather than comparing 500,000 to 500,000, you really should be comparing 500,000 to call it 575,000, assuming maybe a 15% increase in the price of the home over the next 12 months, which is not far-fetched compared to what happened in 2020, 2021. So let's look at this comparison because I think it's a lot more accurate of what you should be making your decisions based upon. So on a $500,000 home with 20% down at 7%, once again, it's $2,661 per month for principal and interest. Compare that to $575,000 with 20% down at 5.75%. Once again, this is the bankrate.com lowest predicted rate for 2024. Your principal and interest is $2,684. The difference in payment is only $23 when doing the comparison this way versus comparing 500,000 at 7% to 500,000 at 5.75%. Because keep in mind, even though the payment's slightly higher doing it this way, you're saving a substantial amount of money by buying the home at $500,000 today versus waiting and purchasing it for $575,000 12 months from now. You're saving $75,000 because you can always refinance if and when the rates drop. So even if you get a 7% today, you can refinance in 12 months or 6 months, whenever it is, when the rates go down. So if that 5.75% truly does become available later on this year, you can still take advantage of that. But the benefit is you actually purchased the home for $75,000 less in this scenario. Because keep in mind, you can always get the lower rate, but you can't go back and renegotiate the price of the home. If you're paying $575,000 12 months from now, you're not going to be able to pay $500,000. That's the point. Here's another strategy that I want to show you where you can get tomorrow's interest rate while paying today's price for the home, right? You may still be stuck on the fact that rates are high and you don't want to pay a 7%, although you're getting the home at what I would assume to be or consider to be a much better price than where we expect them to be later on this year. So rather than asking the seller of any home you're interested in to reduce the price of the home, because you may not know this, but most properties sell for 3% under their ask price. So most sellers are only getting 97% of their asking price or what their list price is for a home. So rather than saying, hey, seller, I want you to reduce the price of your home by 3%, you're actually going to come and say, hey, seller, I want you to give me a seller credit that I can use for a temporary buy down. And you don't even need 3% to do this. 3% would more than cover what you need to do. But if we are looking at a 1-year window, because we're comparing buying now at the beginning of 2024 versus waiting and buying at the end of 2024, right? So it's basically a 1-year window. What we want to look at is a 1-year temporary interest rate buy down. Now, if you're not familiar with what temporary interest rate buy downs are, please check out my video that talks about temporary rate buy downs, explains how they work and what the cost to do them is. In this video, I'm specifically talking about a 1-year temporary interest rate buy down. And so what it means is that rather than having a 7% in our example for your first year of the mortgage, you would actually have a 6% for the first year of the mortgage. So you're getting a 1% reduction in the interest rate for the first year. The cost to do this is actually less than 1% of whatever your loan amount is. So it's truly 0.875% to be exact. So if you're buying the home for $500,000 today, and you're borrowing $400,000, which is 80% of the $500,000 because you're putting 20% down in the example, the cost for this 1-year temporary interest rate buy down is only $3,500. And like I said, if the average home is selling for 3% below the asking price, getting a seller to give you a $3,500 credit on a $500,000 home is easy to do in this market. That will change as rates come down and more buyers come into the market, because there are gonna be more offers on the same property you're interested in. And when a seller has more options to choose from as far as the buyer pool is concerned and the offers they're receiving, they're less likely to contribute toward your buy down or your closing costs, or however you want to use a credit you could potentially receive from that seller. So like I said, using this strategy, you receive a 6% for the first year of the mortgage. It gives you a lower monthly payment, and you still have the ability to refinance if and when rates come down, as discussed before, to the predicted lowest rates possible that the big players are expecting later on in 2024. Where do I think rates will be? I think we're going to see rates in the 5.25 range by the end of 24, as I initially said, but only time will really tell. Where do you think rates will be by the end of 2024? Leave a comment below letting me know what your predictions are, and I will reply to 100% of the comments I receive. If you find the information in this video useful and want to learn more about mortgages and the home buying process, please follow me for more videos just like this one.